It is a very important presentation insofar as protecting people's businesses. It's a topic that's often overlooked, and certainly in all the years that we've been dealing with clients, it's probably an area that clients don't take seriously. Clients don't think the infallible will actually happen to them. But you know what? We've actually got to. You've got to protect yourself in the event that it does. And the reason for this presentation is to step you through the process of how you can protect your business in the event of a life event occurring, protecting your family as a result of such a life event, protecting the business insofar as maintaining the value of that business and that asset that you've created over a long period of time, so that your family can continue to enjoy some sort of benefit from that and from your involvement in the business. The agenda for today is going to be quite simple insofar as Drew from MBS Insurance will be talking us through some of the issues that and some of the things that you can do to help you protect your business and help you protect your family in the event of such a life event happening. What we're going to be doing is presenting for the most of the next 40 minutes or so. If there's any questions, can you please type them in the question box, and I will moderate those questions at the end of the session. I want to introduce you to Drew. Drew is the Managing Director of MBS Insurance, and what was important for us in terms of finding an insurance partner was that they shared the same philosophy as what we did. And our philosophy is to make sure the client's interests are looked after first and foremost. And MBS is an organisation that does exactly just that. Drew and his team are probably the largest insurance brokers in the country. They're totally independent. And in the dealings that we've had with them and the dealings that clients have had with them over the course of the last few years, MBS has always tried to get the best possible outcome for clients. And in some cases, they've turned around, and in many cases, actually, they've turned around and said, well, your existing policy is fine. I wouldn't be changing it. It's that honesty, that integrity, and that going that extra mile, which is the reason why we sort of partnered up with MBS. Drew, I'll throw it to you now so that you can start the presentation. So I'll mute myself. And
thank you, Taz. Thank you for the opportunity, but also the kind words. Greatly appreciated. So what we're talking about today is more specifically buy, sell, and key person insurance. And what is a common misconception is that this is really no different from a cost perspective to a traditional life insurance policy or total and permanent disablement policy, but it is absolutely tailored to meet the needs of the business. Insurance is, for lack of a better term, hedging, protecting the downside. And so we want to make sure that the cover is appropriate and necessary, but also not cost prohibitive. It needs to be sustainable and really fit the needs and requirements of what you're looking to achieve. So the first start of this presentation, I'll talk about business buy sell succession, and this would either be an agreement that is within the shareholders agreement or accompanying the shareholders agreement. But I'll start by trying to present to you an example whereby, three friends, former colleagues, however, have come together because they all believe that they can contribute in a different way, or perhaps a complementary skill set or experience, to creating a successful business together. So in this example, you'll see deliberately owner number one with one child and owner number two with two, and owner number one a single parent, owner number three rather a single parent. And the point being is to try and have you reflect upon, in the event something happened to owner number one by way of death or disablement, and to sort of picture about, well, what happens next? And so what happens from the business perspective and what happens from the family perspective? So as we sort of go through this process and this example, we reflect on, does owner number one's spouse or does another family member, perhaps the executor of estate or someone else, come into the business? Do they try and fulfill that role? Could they contribute in the same way that owner number one could? Would owners 2 and 3 be happy with owner one, or this owner one's spouse rather, or family member, or another proxy, I suppose, being involved? And would the family of owner number one's, would they want to be involved in the business going forward? It is very unlikely the answer is yes to all of those questions. We do have a lot of experience in this space, as well as a lot of experience managing the fallout or assisting with firms such as BDH and their clients who are navigating this process. And I remember recently speaking with the spouse of a similar sort of situation. It was a 2-owner business, a manufacturing company, and sadly, one of the fellows passed away and left a young family. And this had been some years on, but I remember his spouse sort of said to me, it was a terrible situation because, over the period since now and then, I've turned up to board meetings and, typically the agenda is about reinvestment, and this is where we need to take the business, and this is the opportunity, and this is where we can go. And she said, frankly, I've needed the dividends. And so I've needed the dividends to provide for my children and put them through education. And so for that reason, I know that I've sort of hamstrung the business. And I think it's sort of less than ideal from both perspectives. So I want to walk through how that would typically work. So on the basis that, again, those 3 owners came in together into the business because of a skill set or an alignment or an experience that seemed to make sense and seemed to believe that together they would be better at creating the business. So what would we typically do? On the basis that that there is an agreement, you would be working through the business valuation, because if you're having to address this situation after the fact, the question is, on what basis is the business valued? Again, providing that owner 2 and 3 wanted to buy out the equity of owner 1, would they have sufficient funds to afford the buyout? And I'll talk a little bit later about personal liability or personal guarantee rather, and joint and several liability. But these 2 questions are reasonably tricky at the best of times, and reasonably tricky when nothing has happened. When something has happened, it's really a conversation that no one really wants to address, and it's certainly something that causes a bit of angst.
Can I just butt in there before you move on to the next slide, Drew, and just make a point? I mean, if there's individuals coming together to start up a business, I think it's probably the opportune time to discuss this is probably at the outset when you're setting up a shareholders agreement or a partnership agreement, where you're sort of talking about the exit strategies as well, not just we've had a fallout, but in terms of these life events actually occurring. So it's important to sort of talk about those things and discuss those things at the outset rather than when a life event actually happens.
Taz, I totally agree. And we'll talk about different types of conversations as the business progresses, particularly if businesses grow and become more and more successful. But at that point, Taz, it's a reasonably pragmatic conversation. You're able to have a discussion around, well, is passive equity in this type of business, does it suit? Are our families sufficiently financially secure and not reliant upon the remuneration or the dividends, etc.? So when we do sit down with business owners and work through this, we would be sitting down alongside your advisor at BDH to determine with you a valuation methodology that could be documented. And so for that reason, it's able to be applied year on year, whether it be, it would certainly be with the engagement of the clients, because every industry is a little bit different. Typically, owners have some sort of idea about, similar transactions in the marketplace, or at least some idea internally as to what that should look like, because highlighting this is only an internal transaction. For the instance that someone's equity is worth 1 million or 10 million, the insurance company, in the event of a claim, is not determining the appropriateness of that payout. They are simply paying out that money. And so this is, importantly, an internal transaction, an internal valuation methodology. The benefit of engaging someone like BDH is their experience and their knowledge, but also they're able to update this, or at least put on the agenda year in, year out, as the financials of the business change. Now, when you have this documented and you have the situation that arises, touch wood it doesn't, but if it does, it's documented and predetermined, which is a lot cleaner and certain than the alternative. So in the event of death or disablement, owner number one's family would receive a payout equal to the fair value of the predetermined valuation methodology. There are contingencies if that is lower or higher, but certainly owners number 2 and 3 have the ability to continue on in the business without the challenging discussions around fair valuation methodology, around discussions where perhaps an executor wishes to take it to the market, because this was predetermined when everyone was healthy and willing and able and in a position where they could come up in an agreement. They've also removed the likely requirement for additional shareholders to get involved in the business or borrowing large sums of money, which, quite frankly, we've seen situations where that has caused such an obstacle that the business is actually sold in totality, because owners 2 and 3 don't wish to be burdened by that volume of debt and want to ensure that owner number one's family do receive their appropriate payment. And of course, that other example that I said, where I think from an optionality perspective, in most cases, the passive shareholding, particularly at the pre-existing shareholding, is less than desirable for most businesses, particularly if it is a skill set or an experience that is part of the contributing factor to them coming together. So it would be legally documented as part of the shareholders agreement or as standalone but connected to the shareholders agreement. And BDH would review the levels of cover appropriateness with the updated financials, and of course touch base with us as well in coordinating that review. It removes the funding challenges that may otherwise exist significantly. And we have discussions with clients that shareholding does value, as per this example, of somewhere between $500 and $20 million per shareholder. When you have shareholding that gets up to that higher level, it's unlikely that you would insure an individual for $20 million. But you would establish something that is in between. Perhaps it is 5 million or 10 million that is paid out to the family or the estate immediately upon the death or diagnosis of disablement. But it starts the trigger event. If an immediate lump sum of $5 or $10 million is paid, and there's methodology around how the balance is paid, it provides certainty. It certainly provides comfort for family members, in where we've seen that they receive immediate liquidity. And then perhaps the balance, depending on how much it is, and again, it's determined by the internal shareholders, is paid over a said period of time. And perhaps it is borrowed, perhaps it is in equal installments over 1, 2, 5, 10 years, however long it be. And again, on the basis of the type of business that it is, of how that business would progress beyond, and also consideration of how much the initial payment was for. So I talked about an example of no pre-arranged strategies, and sadly we're working with one at the moment where the fellow has 2 adult children, and there's just a lot of opinions, and it's quite emotional and challenging for all parties. And I don't think it's going to end, well, the conversation and the outcome won't end quickly. It's been going on for quite a number of months, and it is very challenging dealing with, valuations after the fact and how to optimize the value and what the next steps may be. So this is a lot simpler than what people imagine it to be. And certainly, through the period of 1 or 2 meetings, particularly given your relationships with BDH and their knowledge and the way that they address client situations, you would find yourself as a client really quickly understanding what this would look like and what it would typically cost.
Drew, in relation to the exiting partner, obviously, or the one that's deceased, obviously there'd be a tax event because they would be effectively forced to dispose the equity interest in the business by getting this insurance payout. Can the having regard to the tax consequence, and obviously you sort of do a valuation on a yearly basis, can you insure for that extra hypothetical tax consequence that the family of the deceased may incur as a result of them having to exit out of the business?
Yeah, and thank you for asking a question, Taz, because I prefer to this as a bit more dynamic to have this engagement. So thank you. You made me think of a couple of things. One, this is a sale event.
Yeah.
They have sold the shares in the business. It is a CGT event.
Yeah.
The second part to that is, at higher ends, if we were talking about levels of cover of probably north of $6 million, the insurance company will be wanting to know how we determined that methodology, because there's large amounts of money, right? If you had a scenario where a business is making very little money, the directors or the shareholders are taking out very little by way of remuneration and dividends, and then we're asking for $10 million each, they'd be concerned that perhaps the life insured or we knew something that they didn't. So at higher levels of cover, they would want to know the methodology and how you got to that at a higher level. Typically, we would not gross it up for a tax consequence.
But doesn't mean that you can't do that?
No, it doesn't mean that you can't. Because the other thing that we would typically do, Taz, depending on the growth rate of the business, so if we looked at financials now, understanding it's October, but the financials we're looking at maybe as at last financial year, we would want to ensure that we're not leaving anyone short. So we'd want to ensure that they sort of at least take the equity component through to July and perhaps beyond. So it's not uncommon to have some small margin of buffer for sure, particularly for growth. And this is a conversation that business owners will typically have every 2 years. Every year seems to come really quickly.
Yep.
The other thing as well is, imagine, Taz, that you and I went into business together and we invested a lot of money and we took no money out of the business for a period of time because we kept reinvesting. We might not have a lot of profit. So we might have an internal agreement that says there's been some opportunity cost. We've forgone other income that we might have otherwise earned. So whilst we don't yet have a financial position to demonstrate, we think it's fair that by virtue of this internal interaction only, that in the event of death or disablement, we both, agree that our shares are worth $1 million each. So you certainly have the flexibility. When you don't have the flexibility, again, is if we were both saying, well, our shares are worth, $8 million, the insurance company would be interested to know how we've come to that conclusion. Can I move on to...
You can, sorry, mate.
No, thank you. I mean, key person insurance would typically exist where there is more than one person. There is tax efficiencies for husband and wives in business together, or single owner businesses for perhaps have insurance inside their own name or super fund. So we can talk about that as well. As an example, really easy example where you've got multiple people who are contributing to the revenue of the business, that in the event that there was a sudden loss of an individual, the question we'd ask is, how would it impact sales? How would it impact expenses? How would it impact the profit? Particularly the fixed expenditure. Variable expenditure we're less concerned about, because if variable expenses exist, typically the business is still going. With this example of being, if you had a business where there is 10 salespeople all contributing 10%, you might not see the relevance of revenue protection as much. But typically businesses budget, or businesses have a strategy that it's around their budget. So if they believe they're going to have, X amount of dollars in sales, they'll typically make decisions around employment, office space, etc., that they're committed to. And so we would just want to provide your clients with the ability to make an informed decision to say, well, if we did have, it doesn't need to be death or disablement, but if we did have a major illness occur to one of our key salespeople, then if that's going to impact the business, we want them to at least understand what that looks like and what it would cost. I mean, the comment to the bottom right of it, it's incredible how often we see businesses insure company cars. We think the loss of a company car, respectfully to determine what kind of company car it is, but businesses insure all sorts of things, but they typically don't insure the greatest assets from an economic perspective. So we would look at how much to cover, and we would pose the questions around, well, is 12 months sufficient? So can we cover the contribution of that individual on a 12-month basis? And that's probably grossing it up. If it did happen, we want to keep insurance appropriate and necessary. We don't want people to be overinsured because they're going to pay premiums for it. But 12 months is a reasonable time where a business can make an informed decision, particularly if they're not financially suffering, on what the next steps are. So we would question first and foremost, well, if this person contributes $500,000 in revenue, can we look at protecting the business in the event of death, disablement, unable to do their own occupation, or in the event that there was a major illness suffered by, in this example, a 40-year-old female, non-smoking, non-blue collar, non-manual worker, would cost the business, $200 a month. And that is an immediate lump sum payment, either on diagnosis or of it being a passing or a disablement. We would also discuss, and challenge, and I expect certainly BDH to be doing the same, is, well, can the business set up processes to better protect themselves against the exposure of key person risk? We have lots of examples whereby it doesn't look like this, where there might be one or two individuals out of the group that contribute a significant amount of revenue, and everything would change if something were to happen to those people.
And in that circumstance there, Drew, obviously the value or the cost of trying to get an employee or to sort of replace that rainmaker, so to speak, obviously you can take different types of policies or different amounts of policies depending on who the life insured is.
For sure, Taz. We often have this conversation where there's a recognition that the business is probably it's not going to be all or nothing. The business is probably not going to lose the total revenue. People are going to be able to pick up the slack. But in those people, they often have an in-depth experience and knowledge of the business and the product and the client base. I've never had a conversation with business owners, and the key person is not always a business owner, whereby the business owners would not say, well, we'd want sufficient enough money to be able to go and offer someone a considerable amount of money or a remuneration package that is akin to the performance. And certainly as an employer, you know, we have about 60 people within the business, and from personal experience, it always takes 6 months for anyone really to find their feet. We always, particularly experienced people, we expect to come in and start contributing, I suppose, a lot sooner than that. But it just always works out to be about 6 months before they're fully aware of the systems, the process, the technology, the clients, the referrers, the colleagues. So that's why we think that a 12-month period is sensible. Debt protection is really interesting, and this is one where any business that has personal guarantees, any business that is acquiring and when they do so require deposits, or the security of family homes to guarantee debt, this is particularly important. And that example again of that same 40-year-old, $1 million death and disablement would cost $70 a month. So it is absolutely just using the traditional life insurance and total and permanent disablement products that the market use, but having a specific purpose around protecting the business. And so that's deeming that the business owns the policy and pays for the policy. There is different approaches about deductibility, be it for revenue or debt, be it for revenue protection or capital protection. And this is one that we see a lot, where if you're a business owner and you are providing your personal guarantee, you should ask your bank if you can stop having your personal guarantee, because if the answer is no, you most certainly need to consider debt protection. Similarly with family homes, we have been involved many times with respect to this and proceeds and meeting with banks. The amount of cover required is typically equivalent to the amount that would have been required as a deposit should your family home not have been available as security, or to not have a personal guarantee. We want business owners to remain in control of their business and not a bank determining what the next steps are, whether the business goes up for sale, whether they're going to try and call in the debt. Because in effect, when someone passes away, they have defaulted on loan covenants if their personal guarantee was a condition of the loan and required. We have many examples, particularly where there's intergenerational business, where parents have gone into business realistically to provide some balance sheet or financial, leg up for children, even adult children, and then the removal of the director due to death, as we've seen all too often, it cause issue.
So in terms of this debt protection, Drew, are we talking about taking out an additional policy over and above the policy that would be covered under for a key person under a buy-sell agreement?
Most certainly.
Yeah.
I mean, I'm a business owner that has, like yourself, unfortunately, our business requires at this point in time my home and my personal guarantee. Now, in the event of a buy-sell, in the event of death, then my equity is paid out. But my equity exists now, whether it's in the hands of my wife or on paper. My personal guarantee exists for a reason. And so I don't want to be in a situation, particularly where Lara, is expected to guarantee this business or our home. And I'm not sure the bank would require that from a third line enforcing, but they'd require something to change. They'd want something to swap that out. And so this is about remaining in control. I've got no interest in, for me, it's imperative that should something happen to me, that my family receive the fair and reasonable value of my shareholding, and that my home and any other assets that we have are not at all exposed by the business. Now, we're in a growing business, and that's why that exists. And I get that, and I understand it. You know, I understand we're going to the bank and borrowing money for acquisitions or what have you. I understand why it's required, but at the same token, this is the whole genesis of this discussion, Taz, is if we protect the business, then, you know, I protect my family and the financial security of my wife and two young kids. So it's not really that emotional for me. It's just about pragmatic. I'm not interested in the stats of it happening or what have you. I just want to be sensible. And you know, it's all, the cost is no different than a traditional life insurance policy. And so that way I know that my business partners will be able to continue on and manage our clients and not be in financial hardship, not have to worry about how they're going to have to come up with the money. And my wife will receive, again, the value of my equity in this business. I might move on to Andrew. Thank you.
Hi guys, Andrew Newton. So I work here at MBS with Drew, and I'm connected with BDH leaders. So do a lot of work with existing clients. So I might come across some of you in the future. I just thought I'd give you just a quick spiel on the company, just so you get a bit of a background on what we do in totality. So we've talked a little bit about debt protection, key person, buy, sell sort of stuff, but you know, just letting you know about the company overall. So in terms of what our product offering to clients, you know, we've got dedicated underwriting with principal underwriters at all insurers across the market. So in terms of access to, you know, life insurance, you know, products and, you know, all that sort of stuff, we've got the best of the best, which is great. You know, and our company, we're specialists in life insurance products, which we'll touch on in the next slide. So it's a lot of planners out there, a lot of you know, advisors who touch on superannuation and investments and self-managed super funds and things like that. But our focus is purely on the life insurance products. So with that, we've got access to all insurers across the market, not aligned to any particular one at all. So our company's been around for about 15 years now, since 2006 when we started. So as Drew mentioned earlier, we're, you know, a growing company, and you know, advisors like myself are coming on board and taking it onwards and upwards, hopefully. So, you know, we talked about life and TPD cover. Income protection cover is the other major one that clients look to get cover for. There's been a lot of changes on that at the moment in the market. You might have been affected by that yourself. That's probably a topic for another day, but these are the four major products. And there's a lot of clients out there that might know, you know, about life and TPD cover, typically through their super fund, and income protection insurance, which is also known as salary continuance. You know, that might be provided through your super fund or your employer. But there's also trauma insurance, which is something that not a lot of people know about, but it's actually something that pays out about 50 to 60% of claims for our clients. So that pays a tax-free lump sum in the event that you suffer from a critical illness like cancer, stroke, heart disease. There's about 50 or so illnesses that are covered under that. And look, truthfully, I think that's the best product. You know, obviously life and TPD sort of stuff is in place, but if you go through a trauma event, you know, it's called trauma for a reason. It's obviously a very tough time and illness that you're suffering from. So if you can get an influx of cash to help you with treatment, short-term costs, and that can align with your income protection cover as well. So though, if you're off work for a period of time and you know, you need some income, and I'm sure all of us do, that's why we work, that's what these products are designed to do. And just moving on to the next slide, just reiterating that we're not aligned with any particular insurer. So there's some advisors out there who only provide advice on specific company products. That's not us. So we think that's a really good thing, because you know, we can typically you know, shop clients around to work out what the best insurer for them is. So yeah, in terms of what we do, as I mentioned as well, we've got access to the best underwriters on the market. So we're confident that we can find clients the best home for their insurance cover. And just briefly moving on, as we mentioned, there's certain target markets, I guess, for life insurance. Young families is, kind of one of the major reasons people get into life insurance when they start a family, take on a large mortgage when they're more financially exposed, particularly when their kids are younger. And as we're, the topic of this discussion today, business owners with key person, buy, sell, debt protection sort of stuff. And then clients as well who have got, doing their tax return and, their accountant might notice that they want to claim on income protection premiums. It's, that's a good time to have a look at a policy review, see if we can improve the terms of your cover, bring down the cost or make it more aligned with your current salary. And as well, clients with self-managed super funds. So a lot of clients typically fund their life and TPD cover for personal protection through their self-managed super fund. So it's pre-tax dollars out of their personal cash flow. So clients like that, if you've got a self-managed super fund and wish to fund your insurance premiums through there, it's a really tax-effective way of going about it. And just briefly touching on this last slide here. So there's a few reasons clients need have a look at their cover. The typical one for clients such as ours, we try and reach out to our clients most years, but sometimes they might get in touch with us after receiving, their renewal notice in the post. Let's be honest, we've all been there. So that's a good time to have it looked at. And as I mentioned earlier, there's things changing in the market in life insurance recently. Income protection product offerings have changed, so that's another reason for review. And other things of that nature have come up recently. So this is what we do Monday to Friday. Weekends as well. We meet clients all around the clock. So this is what we specialise in. So if anyone wants to have their cover looked at, we would certainly like to help you with that. I've just got the next slide here, Taz, as a question slide. So I'll let you jump in and do your thing, and I'll wheel Drew back in.
All right. Sounds like he's old. He's aged in the last half hour. If anyone's got questions, can you please type them out on the meeting chat box, and I'll facilitate those questions. In the meantime, whilst anything's happening, I mean, these buy-sell agreements and the insurance attached to those guys, how's that generally funded? Who funds these things? The business, the owners themselves? What are you seeing?
Business, certainly.
Yeah.
So using that example, Taz, where two business owners and the shares are worth $1 million each, ultimately the family would receive the $1 million. The remaining shareholder, there would be an impact to the business, and whether you address that with key person or not, on top of that, depending on the appropriateness. But the other shareholder hasn't also had to fund that $1 million, hasn't had to go into debt and raise that $1 million. There'd be concern if the premiums for the buy-sell would be a deductible expense to the business.
Yep.
Because we would want that money to go to the family. So we'd want the owner of the policy to be the shareholder. So if it's a family trust that owned it, typically we would advise that the family trust were the policy owner on the product.
Correct. And the point that you're making is critical from a tax point of view to make sure you get it right. Because if you don't, there's some serious tax consequences.
Yeah, and so the other one, Taz, well, what do you do what about if there is a single owner who owns a business, or a husband and wife that own a business and lots of creditors? We would typically like policies to be held away from the business. And in the event that the spouse decided appropriate, they could lend the business back money. So if they received money outside of the business in a tax-free environment, they could then lend, but they would then themselves be a creditor, rather than the business receiving all of the money and understanding that as they take it out, it might suffer tax consequence or at the mercy of other creditors. So I'm making it sound perhaps more complicated than it is. The important thing is that we understand the business. And we will very deliberately and quickly get to a position where your clients understand, okay, is this necessary? Do I need it? What would it look like? How much would it cost? And what are we trying to achieve? And to go through that process would not cost anything, from our perspective. We don't charge for advice. We receive the same regulated amount from any insurer every insurer across the amount, which is legislated. So there is no additional advice fee for this. Obviously, lawyers would require, with any shareholder or legal agreement, we would leave to lawyers of your recommendation or the client's lawyers.
Another question: how, we've broadly touched on personal insurance, and we've talked pretty much about business insurance, but I suppose the personal aspect of it is quite separate to this, and what the topic of this conversation has sort of been, because what we're not dealing with is the liabilities, the loans, the properties that you may own, the loans associated with those assets attached to your personal name or in your personal structure. Do you want to make any comments on that, Drew?
Yeah, that really good question, Taz, and perhaps remiss of me to not address that. But the prior, so in the instance, and to use myself as an example, I determined that Lara would receive X amount of dollars. The next question I would be working through is that sufficient to raise our two sons, and is she financially secure, and what have you. So, but I certainly would be taking that into consideration. I wouldn't be doubling up unnecessarily.
Yeah.
So I'd be aware that in the event something happened, that she would receive proceeds from the sale of my shares in the business, and as long as her family home was unencumbered from the business and our mortgage released, then I would be considering the education of our children and, again, her ongoing financial security. So, but it is a top up. Right, a lot of people deal with it in reverse. A lot of people have a lump sum on the family side without any consideration to what would happen from a business perspective, and it is upside down.
But mostly, I suppose the business is providing a certain lifestyle for the family, and if that business stops there because of something happening to you crossing the street, that lifestyle pretty much stops unless you sort of cater for it.
Yeah, so I'm certainly suggesting that you need to address the personal insurance, but you would have consideration of the equity that's coming through from the business. Yeah.
Does anyone have any further questions that they would like to ask of Andrew and Drew before we wrap up? I've unmuted people, so you don't have to type anything up in the box. No. Andrew, Drew, thank you very much for your time in doing this presentation. Thank you everyone else who attended this presentation over their lunch break. Hopefully there was some benefit to it. We invite you to contact us directly, or to contact Drew and Andrew directly if you have any further questions in relation to your business insurance, your life insurance, your income protection, or anything of that nature. We'd be happy to take inquiries. Guys, before we wrap up, any comments you'd like to make? No?
So that was for us.
No.
No, you guys.
I guess we'd say, look, we're here to help, and as Drew mentioned earlier, there's no fees associated with our advice process. So even if it's just a conversation to have a brief discussion, but get some quotes and things like that, we're here to help. That's our job, and we want to be busy, so please come our way.